All right, so in today's video, we're going to run through as if you were reaching out to me as a buyer, and I'm going to do the full buyer consultation. So you'll know everything you need to know about trying to buy a home in DC, Maryland, or Virginia. So we're going to get right after it. So you reach out, now you want to buy a house. What do you do first? So the very first thing you need to do is try to understand and learn what it is that you can and can't afford, right? So we don't want you window shopping, right? We want you to understand what it is to afford a purchase, to afford a home, and what you can afford. So to do that, we want to explain how they qualify you for a mortgage, and then we'll talk to a lender to figure out exactly how much you can afford. So what a lender is going to do in a quick summary is they take your income, right? And let's say that is $10,000 a month. So they're going to run through, they're going to add up your income, right? So if you make we're going to do simple math. If you made $10,000 a month, that is your gross income. Then what they're going to do is they're going to subtract out all of your debts, right? Your student loans, your car notes, your credit cards, anything that you have that is considered a debt monthly. Then that number, let's say you have $2,500 in bills that you need to pay. You now have a net income of $7,500. That number is what they go off of. And then your mortgage payment cannot be more than 50%, ballpark, 50% of your net income. This means that your mortgage payment, the max it can be is about $3,750. And that's how you get your mortgage payment. Once we get that number with a lender, then we will work backwards and say, okay, based on the amount of down payment that you're going to produce, this is your mortgage payment, this is what you have. And then that's how we calculate the sales price of what we're going to start hunting for you and your family. That's a quick generalization of how the mortgage companies get to the number that they get to. They don't want you to be house poor. They want your mortgage payment to be under 50% of your net income. So after all of your debts are paid. So we're going to do that math. Then we're going to introduce you to a lender. Now you have a few options of how you want to get approved. So the first one is going to be the big banks, right? The PNCs, the Truists, the TD banks, things like that. They're the ones that drive the market because they are more than likely going to service the loan in-house. That means that they are not going to sell the loan. They're going to use it they're going to end up servicing the loan. They have a servicing department. They are typically 9 to 5 workers. They're not going to be experts in the local area, but they're such a big bank that they do have some advantages to it. Now, the second option is going to be the credit unions. Now, credit unions are known for their customer service, but again, they typically work Monday through Friday, 9 to 5. So if you found a house on Friday, you go to the open house on Saturday, and you want to buy that house on Sunday, they may or may not, they probably won't be available to talk to them and get a quote on the house. So the third option, typically the best option, is going to be talking to a mortgage broker. A local lender is going to know, one, all of the county and state programs that you can qualify for if you have the credit and the income profiles to meet those needs. And those are niche products. They also are working around the clock. They're just like they're in real estate, right? So on Saturday, Sunday, you call up a lender and they will get you a quote for that specific house. Now, the quote is going to have your taxes, your insurance, all of these estimates in there. The property, the interest, the taxes, and the insurance quote is there. And then you're going to also have the cash to close. That's going to show you exactly what you would be needing, almost to the penny. It will fluctuate a little bit, but you'll have a great idea as to how much cash you would need to close on that property. All right, so now that you've talked to the lenders, we are approved. Now you're like, all right, great. Someone once said that I now have the license to hunt, right? So you are now approved, and we'll start setting up a search to find out what you like and don't like. Now, the most important thing here is you're going to have to do an exercise where you find out what you need versus what you want, right? Needs are the amount of bedrooms that you absolutely have to have, and wants are going to be something like, I really want a renovated kitchen, or I really want a finished basement, or I really want a large flat yard, right? These are things that you're going to want, and we're going to start to figure out some of the things that you will and will not get in the house based on the price point. There's always going to be sacrifices that you'll have to make. No house is perfect. If that house is perfect, it's going to be probably more expensive, and it's going to yield multiple offers, and it'll make it super competitive, because if it checks all of your boxes, it likely checks everyone else's boxes as well. So you have to be prepared if that unicorn house does pop up to come super competitively on an offer. All right, so now we've got a search set up, and you say, Miguel, I saw this property, I absolutely love it. At that point, we're going to say, hold your horses here. Let's do a pricing analysis, right? So my job here is to identify what the strategy is of the listing agent and the seller. So when you price out a property, there's 3 ways that you can price it out. The first is you can price it really, really high and get a needle in a haystack type property or price where you're trying to find one buyer who absolutely loves the property, right? They usually are a little bit higher, may take a little bit longer to find that person because it is on the higher side of the neighborhood. Complete opposite of that is they price it under market value. And the idea here is that you're trying to get multiple offers. Now, in this situation, if they do that, we're trying to guess how high it will escalate. And then there's no guarantee that it'll go that high, or maybe there's enough offers to go even higher. Now, the third option, usually the most common strategy, is market value. For market value or slightly above. Now, the reason they do this is to get the most amount of eyeballs on the property. And when we identify it, we're going to price it out and say, here's what they did. And so the list price does not matter, right? Because that's a strategy that they used. We're going to identify the actual value of the property and what we think it can land at. We identify that, we tell you our recommendation. Now, at the end of the day, it is your purchase. So we're going to say, hey, if this house is worth $1.1 million, you say, hey, we're not going to offer that because the list price is $1 million, but we'll do 1.25 or 1.025 rather. Then we're going to write that up and we're going to set a strategy to say, hey, this is how we can win with that price. Now, when you're submitting an offer, there's a few things that you're going to need to take account for ahead of time. And we're going to talk through those right now. All right, so when you're ready to submit an offer, you need to account for a few things that you're going to need to expect while you're submitting an offer. Now, there's a few upfront costs to submitting an offer. The first one's going to be the earnest money deposit. This deposit is typically 2 to 3%, but it can be as high as you want it to be, because the higher it is, the more strength it shows, the more serious it is that you are. I like to say that this is like poker chips on a table, on the poker table, right? So this is, you got to pay to play. So you're coming in, you're saying, hey, here's the paperwork for the offer, and here's the amount of money that we're willing to put at risk to execute this contract. And if we don't execute the contract for whatever reason, the seller gets this money as their damages, if you will. Now, in Maryland, you are protected with contingencies, which if you replace the word contingency with protection, that is what we'll talk about here in a second. But the first one is a deposit. That is due usually within 3 days of a signed contract. Now, the second thing you're going to want to account for is once you're under contract, you get to do your due diligence, right? And you'll do an inspection. And inspections can be $500 to $700 depending on the price of the property. I've even seen some of the larger ones can go up to $2,000. Now, that is for a third party, an inspector, to give their unbiased opinion. They're going to give you the good, the bad, and the ugly of the property. You're also paying for their expertise and their report. So they're going to produce a report that's probably going to be like 60 pages. You can use this as somewhat of a home guide. It's going to show you where the water shutoffs are. It's going to show you the electrical panel. It's going to show you how to use the appliances. It's going to show you a lot of info about the property. I still reference our home inspection to this day, and we've lived in our property for years. So that information's great. Then you also can add in other inspections depending on where you're buying a house, right? If there's well and septic, if there's a pool, there are other inspections that you will need to do in your due diligence. Then you've got, after the inspection, about another week or so, you will then do a appraisal. The appraisal is going to be ordered by the bank. Now, unless you're doing cash, the bank is going to also ask for a third party to come evaluate the property, tell us what they think the value of the property is. That will run you somewhere between $500 to $700, depending on the size of the property. You'll then get a report in like 2 weeks' time or a week or so. They're going to say, hey, this is the amount. It came in at value, it came in above value, or it came in under value. We'll talk about what happens in those contingencies in a moment. The last one that you'll have up front is going to be a small one. It's about $50 for a wood destroying insect inspection. This is typically done with the inspection, but if you wanted to do it in a third party, you can do a company like Pest Now, for example, that will come out, $50 to look at it. If there's termites, if there's carpenter bees, something like that, they will inspect it, they will give us a report. There is one more thing that I forgot about that you'll have is a potential radon inspection. Now, depending on how aggressive you want to be on the offer, you will write in a radon contingency. Now, radon is the second leading cause of lung cancer in the area. So if the EPA has certain levels that it has to be under, and we'll do a test. It's a 2-day snapshot of the dirt under the home. And if it becomes an issue, then we negotiate and try to figure out what we need to do. To fix it is about $1,000, maybe $1,500 to fix it, to put in some sort of like a reverse gutter system. They put in a pipe into the ground, they put a vacuum and a suction in there, and it spits it out above the house outside of the home. To identify the issue though, it's about $150 to $200 for the test. You'll get the results in 2 days. That is all of the upfront costs to submitting an offer on the property. So now we've identified the offer, right? We want to submit this offer. Now we'll talk about the contingencies, and contingencies are extremely important because these are protections for you as a buyer. And in Maryland, DC, and Virginia, all three of them are a little bit different. So when you're submitting an offer, in general, it goes in this order. First is in 3 days, you will submit a deposit with the signed contract once it is accepted. Within 5 to 7 days, you're doing an inspection. Now, the inspection, you have 3 ways to handle this. You can do the right to negotiate, which means you can negotiate anything from the report. You can do a loose outlet, or you can do light bulbs that are loose, anything on the report. That's typically the least advantageous to the seller for obvious reasons, and the least competitive when it comes to multiple offers. However, you can do what's best for you. The second option is a tier right under that, where you're doing it as is inspection. This means that you don't have the right to negotiate, but you do have the right to cancel. So you can't come back to them and say, hey, we don't like the leaky faucet, so we're going to cancel this contract. It doesn't work like that. As is, so you take it or leave it. However, if something major pops up, you do have the opportunity to go back to them and say, hey, this is a big issue and we think that you should take care of it, or we'll cancel the contract. Now, the third option is removing it completely from the contract, and you can do an informational session. When you do this, you have no right to negotiate, you have no right to cancel. This is giving you access for planning in the future as to whether what is the honey-do list that you're going to establish when you move into the property. This is the most aggressive when you're submitting an offer because it is not tied to the contract. You're basically writing in that you want access once to do whatever due diligence it is you want, but you cannot cancel. This means that your deposit that you put down is at risk. So that's the first contingency and/or protection, right? The next one after that is the appraisal. So when you do an appraisal, there's a few ways to write it again. The first one is going to be with the right to negotiate. So we do an appraisal, the bank comes back, and if it was a $1 million property and it comes in at $980,000, there's a $20,000 delta, right? The difference is $20,000. In order to handle that, you have the right to negotiate as the buyer. So you can tell them, hey, we are not going to pay the difference, so we expect you as the seller to bring that price down. And it's a negotiation, right? You go back to square one. So it depends on the terms of the rest of the deal, but we'll get it done. The other option is you can waive the right to an appraisal. Now that means that if it came back in this scenario at $980,000, then you do not have the right to negotiate. And the expectation is that you would pay that $20,000 or rework the numbers with the bank to understand what the mortgage payment balance would be and the difference in the mortgage payment monthly. Now, sometimes there's something in between, right? So if it's $20,000 difference, you can try to negotiate $10,000, $5,000, whatever it is. But that's another protection that if nothing worked, you would cancel and get your earnest money deposit back. The third one is going to be the financing contingency. So this is kind of in tandem with appraisal. It's on the same document, but it's different because you stipulate within X amount of days, usually 15 to 20 days, you're saying the bank is going to submit a conditional approval. So what that means is with a conditional approval, they're going to deliver a notice to us that we send to the seller and says, hey, you're conditionally approved based on one last verification of employment, based on whatever conditions, outlying documents that they still need to get from you as the buyer. But they're confident that they're going to be able to issue the loan. Now in Maryland, or actually in Maryland, DC, and Virginia, until you deliver that finance contingency and says that conditional approval is delivered, you are protected pretty heavily as a buyer. So any of these contingencies with the timelines that we map out on the contract, you are protected for it. However, the moment that we deliver that conditional approval and the finance contingency is removed, then we as the buyer side are now in default if we did not perform on the contract. So that deposit, whether it's $10,000 or $50,000, once we deliver on all these contingencies, your protections are removed and it is now on you as the buyer to get to the closing table. For example, I had a family that was buying a condo. I was the listing agent. They were buying a condo in DC. 3 days before closing, we had already gotten the conditional approval, and 3 days before closing, they bought a car, and that severely jacked up their debt to income ratios that we talked about before, and they could not afford a property anymore. They were in default, so they forfeit their $4,000 to my seller, and the seller was forced to go back on the market. The $4,000 was their damages for the month and a half of the contract, so that paid the mortgage and extra marketing fees that we had to incur, or the seller had to incur, to relist the property. So don't do that. In this scenario, once you've delivered all the contingencies, you need to deliver on the contract. And the conditional approval is stating that the bank is confident that you can do that. So once you do it, it is now on you to deliver that contract. Once you're under contract, or once that happens, then you're going to do the final walkthrough. This is the final step to getting your keys, right, and signing. So the day of closing, usually, or 3 days before, up to 3 days before, you'll do what's called a final walkthrough. Now, the purpose of the final walkthrough is to see the house one last time before you sign, and it has to be in the same condition as, or better, as to when we saw it for the last time, whether it was a contract or whether it was a home inspection, depending on how we've written the contract. When we do this, the goal of it is to identify, one, if they agreed to do repairs during the sale for the home inspection, and we want to make sure that they're identified. We'll ask for receipts, and we want to see the work being done, if there was lighting done, or if there was a sink replaced, whatever it is, a faucet replaced. We want to make sure that that's there. We also want to make sure that there's no holes in the walls, right? Because we likely saw the house when it was occupied. Now that it's empty, we want to make sure that when they moved out, there wasn't a giant patch of carpet that was missing under the furniture or something, which has happened, by the way. Or we want to make sure that there's no holes in the walls, or the TV's mounted and they actually did a terrible job and there was a giant hole behind the TV. Whatever it is, we want to make sure that the house is in the same condition and it's an acceptable condition for us to sign right after. Then we'll head over to the attorney's office, escrow title company, and we'll get the documents to sign. When you get there, you'll have a huge packet, and you've seen some of these documents before. Once you sign those documents, you'll get a key, and congratulations, you are now a homeowner. Hopefully this walkthrough was helpful. Again, my name is Miguel Saba, Vice President of Compass here in our Potomac office, and we'll do this. This is the buyer's guide. Now we're going to jump into the seller's side. So like and follow for more, and hit that bell for notifications as well. Thanks. Bye.